start the session now with a 7 minutes delay. We're not many people in the room. Maybe we can make this a bit interactive. As you know, this is a question and answer session, so there is no topic programmed. It's you who will guide the session somehow with your questions, with your comments and dots and any subject that you might want to discuss related to trading, or with a special focus on technicals. Then I will be at your service during the next hour. Let me just launch the platform. This is a virtual desktop interface where I have the platform on a different server. Okay. Now we can check. Here we go. Okay. Hope you can see it. Don't know if we will need the platform at all, but just in case. Philip is throwing here the first question. What is the best online currency strength tool, and how can we use it? Let me just switch to the camera to our FX studies tool at FX Street. Hope you can see it. I'm on fxstreet.com here, and this is the FX studies. It was the prior currencies at a glance section. Well, it was not a section in itself, but part of the site, and we are revamping it and bringing in new studies, new tools, and this is the format. It is still in beta, I guess, but there are already a lot of widgets into it, and there will be a lot more. We'll be concentrating on this part of the web very strong during the next 2 years. So I guess there will be a lot of new stuff. I've been myself preparing a lot of new studies to add to it. The widgets that you can find it here now are, well, very basic right now. That's for performances and patterns and yeah, a bit of chart as well. And you can see it's organized by tabs. It's organized by tabs. You can also create new tabs. You have different pre-made tabs by topics or pairs. Okay. And you can share them. This, which is quite interesting. In that case, we would let's create a new tab perhaps, and we would. I think I have one with breath. Don't need to create, but I just create this breath tab and not long ago, and here we have two of the tools that we are currently displaying, where you can see strength. Perhaps I will put that one first and explain you after what the bullish percentage index is. We have the currency strength chart. Can you see it? Can you see it well? The chart I have. Philip, is it okay? Okay. And you see, you can customize it or choose the currencies you want to build the indexes. Basically, what this tool does is it builds a basket or an index for each currency based on a series of other currencies. So it values one one currency against the others, and we are here basically building the index with majors and some minor currencies. Okay, but there are no exotics or so. We are just building with the currencies that you see displayed here, and you can then build the indexes or here display the indexes that you want to show. Okay, and on the here below you can see for each color you have the currencies. It is displayed once per day, so it calculates at end of day with end of day data based on GMT. Yes, Philip. Basically, this is telling you which currency is. It's in terms of currency, not currency pairs. Which currency is, when valued against a basket of other currencies, which one is the strongest and which one is the weakest, or what the range among them. And basically, what you can do with it is you can construct your pairs by looking at which currency is the weakest and which currency is the strongest. From that moment on, you can have a quick view on which pair is moving the strongest right now. Okay, if there is any movement, in case you see all the lines like we have here displayed for yesterday's close data, there is no substantial deviation. So they are more or less all in the central range. Okay, but the idea is that so that you can build your own pairs. No, it's not intraday. We are, like I said, we are starting with end of day data, but going into intraday data is one of the things that we want to provide. But right now it's using end of day data. Yeah. Otherwise you could change it. There are some widgets which can be changed to intraday, but not this one. Not right now. Not right now. In any case, if you find any currency strength tool or chart, the way it will be calculated will be more or less based on index building. Okay, you can build indexes by weighting each component of the index equally, which would be an unweighted index, so to say. I think that one is an unweighted index, and there are other indexes where there is some weighting, where some currencies have more weight than others. Okay, like for instance the dollar index. Okay. The beauty of having an unweighted index is that it allows you to compare with a weighted index, with a more traditional one like dollar index or so. You can compare, because what the unweighted index is telling you is based on pure price action without weighting the importance a certain currency has, or in terms of the volume being negotiated in the market. Okay, and that is the case here, and it is usually a tool for detecting extreme levels, extreme deviations, when one currency and the other deviate a lot from what would be a central value or a equilibrium value, and usually it should be used as a mean reverting tool. That is, if you find, for instance, a pair that is highly or two currencies that are highly deviated from the center, like here we have yen and Swiss franc on the 24th February, then you might want to check on a chart what is happening with that pair. Okay, you build the pair here synthetically, and then you watch for levels on that pair and try to trade back to a mean. Okay, it's usually less risky than trying to chase the trend and going after it. Let's check here, for instance, on the 24th February, the Swiss franc yen. Can you see the line? It's we put it in a different color. No, not in black, but in purple maybe. Okay, you see this line here at the end of. Okay, we put another indication here. Okay, so at the end of the 24th February, we had that signal. Okay, we had that signal that these two currencies are deviating a lot from the mean. Okay, and here we see we have a situation where a day later there was a mean reverting movement. Okay, so as you see, in that case it worked quite fine. Although they were not at extremes at the same time. They were peaking on deviations on different days. But at least we can see the movement, how the movement was in the cross. Okay, in the Swiss franc yen cross. Okay. And then this is a chart only displaying supporting and resistance levels. Yeah, but we can see there was a upward sloping channel which was broken to the upside, an upward sloping channel which is broken to upside is usually a very impulsive move. Those who work with Elliott's wave know that it's usually the building of a wave 3, which is the largest one, is clearly an impulsive movement, but that in any case after wave 3 there is always a correction, at least to provide a way for the renewed path for wave 5, for the last one. Okay, and we could have read these in Elliott terms, like wave 1 here, wave 2, wave 3, 4, and 5. Okay, and then A, B, C, or we will now be making wave A from the larger correction. Okay. So if you have a break of a channel in wave 3, it's usually already very risky to go after the trend at that time. Okay, so what you can do is just once you have identified that wave from being the largest one, and from there on, you know where you could be entering in the fifth wave, for instance, or even trying to pick the wave 4, the correction wave 4 to the downside. Okay. By displaying these levels here, this was a parallel line from this mega support, building a potential sideways downward sloping channel. We could have more or less here the target for that correction. Okay. Well, this was a bit beyond the question in itself, but it could be one of the uses. The other one, let me check back to the tools that we have on here on the Forex studies. The next one we have is a bullish percentage index, which is this one. Okay, the bullish percentage index is a tool that is usually known for stock traders. What it does is it calculates an index as well, In that case, the index used for calculation is based on 21, the most 21 traded currencies in global markets, according to the the International Bank of Settlement Statistics from 2007 2010. According to, there is a volume by ranking. We took the most traded, the most 21 traded currencies. We build the indexes, and the calculation is based on a point and figure chart. For some of you who have attended my sessions on point and figure, you know that point and figure are always bullish or bearish. There is in the way you read the chart, there is never a sideways situation. You can always translate them into a bullish or bearish situation depending on the last double top signal being printed, and in case of double top, there is a different interpretation, okay, of what a double top is in point and figure charts. Basically, what the index is telling is for each currency measured against other 20 currencies, how many of these pairs are printing a buy signal on the chart, on a daily chart. Okay, and this is basically a breadth measure, which is quite unknown for the forex market, and here we have attempted to design such a tool for the forex market. Well, Renko and point and figure have as far as I know, I'm not a Renko expert, neither a point and figure. I know point and figure, how to work with it, but not so well about Renko charts. But they share the same philosophy in the sense that they eliminate time periods, or at least the time segments, like we have in other chart formation, other chart types. But which one is better is I don't have a choice really. I know that there is a lot of literature in point and figure, and the reading that we could extract from it is a study on support and resistance, maybe on those areas where most of the negotiation took place. So in order to avoid those levels, try to make decisions on levels where there was not so where price didn't spend a lot of time consolidating. Because point and figure charts, and I don't know if this applies to Renko, are basically for breakout trading, and that is the risky part of point and figure. But for analysis, it's a great tool, I think, because it eliminates a lot of noise and also the time, the regular time units that we have on other chart times. Yeah. And especially for the forex market, it's quite interesting, the point and figure, because it's a 24-hour market, which is perfect. It's perfect for a point and figure, and I guess for Renko as well. And it's a great help for traders, because eliminating the time periods, the regular time periods, it also lets you focus on action only, where the action was. Because our perception of time changes if there are a lot of events, movements, and things happening on the chart. Our perception of time, or cognitive perception of time, changes. It's different from those days or periods when nothing happens. It's the same as in our day-to-day life when you spend a day where a lot of things happen, or you could do a lot of things. The perceptions, like time is expanded, like the day is was larger than usually, and the same happens when we are in front of charts and nothing happens. And also another point is that usually the trading platforms or charting platforms usually fit the price action into the window, into the monitor, and you have always the chart inside the same window, and the distances in the price axis, they change, but the action seems like having always the same proportion or the same dimension, and that changes. It's only the software adjusting the price action to the window, and maybe nothing is happening really. There is only noise, but because the price action is adjusted to the window in our screen, it seems like something is happening, and maybe we are just moving in a small range, and we feel tempted to react to that information, to that action, and it's not significant at all. And in a point and figure chart, you don't have that problem. Okay, so I hope this was helpful for Philip. There are other widgets which you could try for as for strengths. You have the heat map here, which is a very simple measures. You will easily find out. And here, let me just click here on the tool. You can see there are a lot of widgets you can choose from. We were here at the breadth tools. You have, for instance, confluence meter, and it's a quite interesting tool as well, and several others. You have real-time charts, so you can compare the current situation with a chart, which is displayed in the window. And by clicking on here, you add a chart. Okay, and here you have it. And there are a lot of on fundamentals as well. The calendar is there, and there is a countdown for the next expected economic event, volatility trends, pattern recognition. We have pattern recognition right now for candlestick patterns. Bar patterns will be added soon, and so on and so on. We'll have a sentiment section with COT data. Also, will be quite useful. Fine, welcome. Boik is asking, what is your opinion of trading 100% technical and not being concerned with news data releases? Well, I would not position myself in very strictly here as to using just one or the other. Perhaps I tend to be more technical, but there is this belief that all the information that is released or expected in the marketplace is discounted in price, and this is partly true. The point is that this is a belief that was shared by the efficient markets theory, especially during the 60s, 70s, up to maybe the late 80s, 90s, and we are still under the influence of this theory. With time, it became softer in its versions, but its premises were that the market discount everything in a rational and very fast manner, and we later on we could learn that markets or market participants do not receive the information at the same time, nor do they digest that information as fast as we thought they would. Okay, in that sense, when an event, an economic event is released, an economic data is released, there is an initial impact in the price, but the result is not immediately or entirely discounted in price. It takes some time, okay, because not all participants react at the same time. The information is not spread to all participants at the same time, okay, and market participants have different time horizons, so they may take that information and process it accordingly to their time horizons. Okay. The point I want to get into is that you can't get all the information from price. It's not everything is mirrored or discounted in the price. So a little bit of analysis of the current situation, which data is going to be released when, at least if knowing when the data is going to be released is I think it's something you should know. You should be prepared to know when data is going to be released and what type of data, which is the statistical impact it has. Okay, something that you can see from our calendar. Okay, let me just go here to the calendar. Yeah. So we are here now in the FX Street calendar page, and by expanding each of the economic events or data releases, you can see there are associated news, associated reports, and here you have also an history of the event and the market impact is measured with a Olsen scale. Okay, so you can have an idea of you can also see the impact grade which the specific event usually has, and you can compare the history of the releases to a price chart on your charting platform and see and make some correspondences. So a little bit of awareness we should have. Yeah. I don't know if this answer to your question is someone here who wants to add some points to what we have just said about the currency strengths, or how to work with technicals and fundamentals. Just feel free. We are not many people in the room, so it will be nice. I know you can't speak. If you could, you would have probably a better microphone than mine. But you can write on the here on the chat. Is anyone right now testing a strategy or building a trading strategy or back testing it? Something that we could probably make a little bit of brainstorming as for the strengths and weaknesses of Gunstern. Feel free if you want to share with IDX, OSMA, stochastics, ADX for trend I guess. Then you have the OSMA is the histogram. I guess the histogram of the of MACD histogram and stochastics. You are using two oscillators. Two oscillators. Are they providing the same information, or do you have you are you using different parameters so that you can get different information from each? And it will be also interesting. OSMA RSI for trend following. Okay. Yeah, it's an interesting feature of the oscillate of the I guess it's the OSMA you mean is an oscillator from moving averages, which is usually based on the MACD, the histogram of the MACD, plus RSI for trend following. And the MACD is an oscillator which is excellent for not only as an oscillator for range trading, which would be the traditional use of oscillators, but for trend detection. And ADX above 30 or between 30 positive and negative for trend range tiebreaker. Interesting. Yes, Philip. Yeah. Andre is using ADX as well, and very selectively. In fact, he's using ADX in order to be selective as for MACD, or he uses, I think, also an histogram of MACD and stochastics, and he switches from one to the other depending on the message that he's getting from ADX. And he has a very precise system, or a very precise way to trade. It's really beautiful to see, because it's perhaps, if you are new into technical analysis, it takes a time to understand his model, but he devotes a lot of time in his trading room every morning, every evening, with his students, and I've rarely seen someone who is so precise to the pip in his chart reading methods and decision making. Is very, very beautiful to see. Oh, Boyke, yeah, sorry. Did you write the Learning Center? Yes, I did. It was written in around 2008, and hopefully I could. I'll have the chance to work on it again this year, making some sections. Developing some sections of the learning session of the learning center with new quotes and updating the links and and updating the whole education with the learning center. Oh, thank you. Maybe we want to just to switch here to my charts, just showing you something here, because I'm using an MACD RSI combination as well. Usually I trade with two charts. I use one chart only for support and resistance analysis, where I start with horizontal levels. On larger charts, I go into smaller ones, and then I display also channels and diagonals. And once I have a clear map of supply and demand, then I go into the technical model, where I use a combination of indicators. And here on the indicator window, you can see the purple and black line this is an MACD, but this MACD is, you see the values 30, 36, 81, 18. So it's a very lagging oscillator, so to say. I use it for trend direction and also trend strength. And you see, I lag the indicator a lot, so it's reacting very slowly to changes. And then I have an RSI a bit accelerated with 9 periods instead of the 14, which are the standard setting. I use 9 periods. Basically, when an MACD cross is pointing in one direction, then I will pay more attention to trends in that direction. I would favor trends in that direction. Yeah. The short lines are pivot levels. They belong, in fact, to the support and resistance analysis. It's better seen here on a 1-hour chart. It's the green one is the weekly pivot, and the other ones are the daily pivot levels from the central pivot point to up to three support and resistance levels. It would belong to the support and resistance. Yeah. And there are two types of entries. One would be a positive feedback type of entry, which would be a thrust in the direction of a trend. Basically, let me show you one example, a recent one. So let's see from here on. You see the red arrow corresponds here to the MACD crossing to the lower side. So from this moment on, I'll be looking to enter into a short position at a retracement, and the retracement will be seen here in the RSI. The RSI crossing from above 50 to below 50. Okay. In that case, we will have a cross here on that point, but it's invalidated through a positive cross in the MACD. So there was no more signal. We have to go back to find a valid signal. We have here no, it's also filtered. Let me see one that is not filtered. Here we have one, I think. The cross happened here. We see the red arrow. And the first RSI cross below 50, we have it here. Let me put it corresponds to this oops, one more here. Corresponds to this. Let me perhaps make it a bit bigger. Where is it? Okay, it corresponds to this candle here. Okay, basically what I'm looking at is that once I have this is a kind of positive feedback, so to say, entry. I'm entering in the direction of the trend after a thrust in that direction. So I'm reacting and going in the same direction as the price is going. Okay, but I want to make sure that the origin of the movement is somehow protected with some key levels. We see here we have one level, which is the pivot point. Okay, and I want to make sure that in front of the movement, I have at least an equal distance from my stop, which would be placed on the other side of this barrier, so to say, an equal distance, if not greater, for the risk reward. Okay, to get a risk reward at least of 1-to-1. And in that case, the taking profit would be here. Okay, it's not the best situation in the sense that I would like to have more than one level here protecting the stop. Okay, so confluence is an important thing. I want to have confluence of levels, assuring that this position originated in a level which is where I can protect my stop. Okay. Philip is asking, during a trend, at what exact point do you decide that price is now in conjunction? Then at what exact point can you consider the price to be in a trend again? When I using my model, I consider the price is trending if momentum is still expanding, so to say. It's still expanding. Okay. The moment the momentum starts to shrink, so to say, a shrinking of momentum may mean two things: or we start a sideways move, or we revert totally direction. Okay, that is something that you don't know. Oscillators are sensible enough to detect a deceleration in the price series, but they can't provide you the information if that reduction in acceleration in momentum is leading to a sideways movement or to a change in direction. This you don't know. You have to have a few clear rules as far that. So in my case, if we have a clear sideways situation in my indicator, which is providing trend direction, then I would go with caution here. I would go with caution. Okay. The best is in fact if you have a retracement and the retracement was fast enough and large enough for the trend indicator which you are using not to detect it on that same time frame. Okay, let me explain you with an example. You see here we have a green arrow here. Let's see accordingly to this model, we are switching to long from this moment on. Okay, momentum is expanding, and here we have a reading, RSI reading from the highs of the RSI here towards the midline, the 50 line. Okay, but while the RSI was registering the correction in price, the trend indicator, which is in comparison to the RSI, has much slower parameters, is still pointing to an enlargement of momentum. So that correction that we see here in price was fast and of a great magnitude. Okay, so that the trend indicator had no time to reduce momentum level significantly. Yeah. and here we have then a new a new breakout above 50 on the RSI, showing a last thrust going up here to pick that high here, confluent with one of the pivot levels and so on. Okay, but the idea is is that when choosing the parameters, you don't have. That is why I asked before if you are using two oscillators, that you use different parameters in order not to be filtered out every time because they are giving you the same message, or because they are too close in their measures, even if they are measuring different things. But if the parameters are too similar, then you may get conflicting signals. The dotted lines belong to the pivot points. Yeah, it's the support and resistance levels of the pivot point indicator, the daily pivot point. There was a second part of Philip's question on mean reversion. He's asking, is it better to trade the moves away from a long-term moving average or the return journey back to an MA? Well, I guess asking for which is better, there is really no clear answer if we take into account that a technical analysis, at least with number-driven indicators, is a question of a probability which you can answer in terms of quantity, not quality. So it's difficult for me to say which one is better. Conceptually, if you have a mean reversion, which is in itself very fast and of a certain or a significant magnitude, you have like a rubber effect where you have still a lot of positions pointing in the direction of the prevailing trend. So usually to change the direction of a trend, and it's not done in one single movement. Okay, prices somehow have like a physical inertia. We are not speaking of a movement of a physical object, but they have a certain inertia, in the sense that in order to change direction, in order to change polarities, and in terms of supply and demand, it does not happen in just one moment. It takes time for positions to switch, and in that case is when markets provide second and third chances to get on board of a new movement. So perhaps the mean reversion, in that sense, the mean reversion to take the return back to a central tendency value when the market is overextended or has overshooted, is interesting from because you are providing liquidity when you enter counter to that movement. You have an extended market, you have an extended exuberant move in one direction, and at a certain point the movement becomes difficult to sustain, because let's say if the movement is upwards, at a certain moment there are no more buyers willing to enter aggressively at the highs. Okay, a lot of people will be probably watching the movement and wanting to participate, but not at those higher levels. And this is what usually happens in a bubble, and we see micro bubbles every day on an intraday scale, right? And so entering counter to the trend on that exuberant movement is risky because you are going against a train, so to say. But on the other side, you are providing liquidity to the market. You are stabilizing market with your strategy, and you should be rewarded for that if you build a model based on that concept. Obviously, you have to build it and test it, but you'll be rewarded for the fact that you are providing liquidity to a level where your market maker will probably be thankful for you to trade back to the mean and not against, because you will have the broker, the market maker, will have to compensate those orders in the real market, and at some point it's going to be difficult. Okay, so you will be experiencing less slippage, probably trading back to the mean than trying to chase that trend. Okay. The other part of Philip's question was to trade away from that central tendency value, from that moving average, for example. Okay, and this can be also measured in the sense that when prices revert, or let's say when prices overshoot in a large measure from a central tendency, usually the way back to that mean is done in a way that prices do not stop at the mean itself, but they cross the mean to the other side. Yeah, cross the mean to the other side. But consider the strength of the prior trend, because, like I said, the trends do not change direction in just one move. Okay, and here is perhaps a little bit of Elliott wave enlightening in that sense, is why trends are not changed in a single move. Okay, and I may provide you with some insights as for deciding which type of strategy to build. Boyk is also asking, the dotted lines and the short blue. The short blue is a 200 moving average. Yeah, the short blue is a 200. The red one is a 50. Well, conventional chart measures here. Nothing special. I mean, the only indicators I probably use, which are not very common, is these yellow ones, which are the Tilson's moving average, which is an exponential moving average of an exponential of an exponential of an exponential, and so on. It's a very lagging indicator. So as you see, I like lagging indicators a lot. I like, if they are not enough lagged enough, I lag them by setting them to larger periods, like I have done here with the MACD. So if you hear someone saying that indicators are lagging, well, you can make it of an advantage, the fact that they are lagging. And well, I'm contrasting these obviously with a very fast RSI here of 9 periods, and some discretion. Use of some discretion, and as far as support and analysis goes. Okay, support and resistance analysis. Pardon. Okay, I think we have covered some interesting points. Lagging cuts out a lot of price action noise. You can see the underlying picture. Yes, this is one of the. Yeah, I don't want the trend indicators in that sense, as the MACD, to pick every movement in price. I'm not interested in that. So just wanted a filter to say now we are long, now we are bearish. Maybe this is obviously something subjective, because um, why would I say I'm bullish from this moment on, or bearish from here? Why not from here? 10 candles before or 2 candles after? And this is irrelevant. I mean, it's just a guideline. Yeah, just a guideline. I mean, but if this guideline provides enough signals, and if I can filter those signals with a bit of common sense, as for support and resistance analysis, then I have my few trades a month that and uh, and if I want to trade more, I just simply go on lower time frames. If I switch here on the 1 minute, for instance, you see the dynamics are the same. The price is price is reacting to these lines in the same way. See how prices react to the lines. So it's nothing magical about this. It's just a guideline. And how about the non-farm payout situation tomorrow for euro? Well, I've been a bit out of the markets this week, and usually do not pay really much attention as for non-farm payout on on the first Friday of the month. Is usually a situation I try to avoid, but there's a crystal ball. who you see, who has a crystal ball? I want to know it. But uh, but we'll be covering it in any case. We'll be. Yeah, I don't have a crystal ball for sure. That's why I have to study so much. Uh, but well, in any case, we are pointed here to the downside in euro dollar, and probably markets are just discounting that, and we could also have a situation where both uh, good and bad results tomorrow will be dollar bullish. You see, it may happen that we have a situation where if you have a big deviation from the expectation in the positive or negative territory, we could have both positive readings for dollar. So we could in any case, as for my model, let me check here briefly my euro dollar chart. Yeah, I have no obstacles until 29.70 or so. So in that case, there is free fall assured, and but take into account that it's a holiday situation, that the whole thing can revert on Tuesday when all the folks come back from holiday. So yeah, here on on my daily chart, I have I'm inside the Tilson's band, so this is a an obstacle the price has to unwind. So the crossing of a Tilson band always takes a lot of momentum out of the movement. It's a really strong wall. It's really a strong wall. So I would not take any action now. As for euro Swiss franc, well, yeah, it dropped. It dropped because why is everyone believing that a 1.2 would hold? I mean, it's just words. We had some facts. True, we had some facts, but why is that belief that they will buy at 1.2? That they would make a favor to anyone going long at that level. They would make a favor, and central banks, they intervene very aware of how other participants are positioned, and they will not intervene if we are all positioned long in euro franc Swiss. They will not make us rich. That is not their proposal. In any case, they want to profit from that trade. But here I can't speak a lot because we are on a public session here. But I would like to see that thing drop. Yeah, drop until the perception of market participants clearly abandons the idea that the 1.2 was a line on the sand. Yeah. By the way, we had an April's joke. Let me just show you here. But here we had bajista is bearish. So it's in Spanish. I let the programmer who programmed me the indicator is here from Spain, so he put bajista for bearish. I just wanted to wrap up the session here with with a joke we had. Can you see our Facebook page? We had this April 1st joke here that Switzerland will value the Swiss franc against a basket of currencies called the altitude weighted index. Maybe well, it was it was a joke, obviously, but I choose to well, we have here our department who is in charge of the Facebook and Twitter and the networks. And on last Friday they asked me for April's joke, and well, I had a lot of fun. April Fool. I had a lot of fun because I choose to make a joke on the Swiss franc because everyone. Kate. Yeah. Oh, welcome, Kate. I am to Guru status. Thank you very much. It's a honor. But it was a purpose behind it, just to shake a bit our perception and beliefs that there is now the Swiss National Bank making us rich, by buying at 1.2. And there are some truths to it. I speak about Chilean miners, and in fact, there in the 18th century, it was found that Chilean miners they got their salary paid in a variable according to the price of metal as traded in London. So this was in the 18th century, and it was found that Chilean miners they draw the price changes on the walls in the mines, yeah, and they perfectly recognized some patterns, and they could know when in the months following they would be making more or less money accordingly to the pattern. So for them, heads and shoulders and triangles, all this was known to them. Yeah. At the same time, when in Japan, patterns were being developed for candlesticks and so on. So we have the beginnings of technical analysis in these very interesting situations. It's very tied to real market conditions in case of Chilean miners, detecting heads and shoulders and so on. It's a very interesting story. So I mixed a bit, I mixed a little bit of reality and also and in fact the weighted index, the AVI, this was the situation of the Australian dollar. The Australian dollar until the 80s was also pegged to a basket of currencies. We think now that the Australian dollar is freely traded. It has been always so. It's not. The current situation as we have the free floating condition is not a natural thing. And it's not very historically very old. So we should be aware of that if you want to trade these markets. They should have kept the stripe. Okay, thank you very much for your attention. I've things to do here. We'll switch back to some internals here at my work. So thank you very much for your time, for your participation. It was a great session. Hopefully we learned something together, and hope to see you sometime soon. Thank you very much. Bye bye.